Well, farmers have yet to really get into the teeth of harvest for 2016 crops, but it's not too early to talk about 2017. And of course, we started surveying growers in August, trying to find out what they may do. We found farmers expecting to plant 1 million acres less corn, 750,000 more soybeans, really cutting back on wheat, particularly winter wheat, down 1.75 million. That would be down to 49.1 million. That's lowest since 1970 if achieved, and basically about as low as we've gotten in wheat since World War I. And when you start looking at some of the profit forecasts, again for the 2016 crop you're harvesting now, the blue line here is corn. This doesn't include any ARC payments or hedging. Shows $100 an acre loss, so not too optimistic. The soybeans looking much better. Again, that doesn't include any sort of hedging. So I think the prospects for 2016 much better for soybeans and corn, and that trend continues for 2017. According to my early projections, corn still showing a $100 loss, but soybeans showing a $50 to $60 per acre profit if things pan out the way I think they will. Now, the soybean to corn ratio for 2017 got up to 2.56 to 1 and backed off a little bit. The trouble is that the new crop prices for both crops are not very good and certainly not providing much incentive. The good news for corn growers is that production costs will be lower. Your fertilizer bill may be down as much as $35 an acre. The cost down less for soybeans, of course, due to the fertilizer, less fertilizer needs. Cash rent's also lower. So what this is doing is lowering that cost of production for corn, maybe down to $3.75, $3.80 per bushel nationwide. And again, we have to kind of fit our reality to this new perspective, and it means that we can start hedging this crop on only modest rallies. Fertilizer prices have broken sharply over the last couple of years. This is urea. I think you can target the 285 area for that. We did see a little bit of a bump in August. India started doing some buying. China also stayed on the sidelines and waited for India to make some big deals before they started selling their inventories. Ammonia prices, real weak link here. The index used to sell contracts at the Gulf may be down to as low as $200 a ton, and that's lowering retail prices as well. We've seen prices on the plains closer to plants, below $400 even in Illinois, talking $475 to $500. So some real good potential. Even if you're not putting on fall applied fertilizer, I think it's a good idea to take physical control of it, if not in on-farm storage, then with a firm commitment from your dealer. The supply chain in fertilizer can break down pretty much at any time. The satellite rainfall maps that I take a look at showed some parts of Louisiana getting 37 inches of rain or more in August, and had those storms fallen 50 miles, 100 miles further east, right over the Mississippi River, the river system would be closed right now. We all remember what happened back during Hurricane Katrina. So these supply chain issues can happen almost at any time with pipelines, rail transportation, or the river system. So good idea, I think, to make sure you have the fertilizer when you're going to be needing it. Phosphate supplies also continue to increase around the world. A lot of production coming on out of North Africa, the Middle East, even though U.S. production is lower from Florida due to environmental concerns. So as those stocks build, that really has broken prices for DAP. Prices were stagnant for a long time, but they've come down quite a bit. It looks like they're trying to bottom. Now, for all these fertilizer markets, it's hard to get very bullish until crop prices turn around. At the same time, you can't get a whole lot more bearish because we've seen that when prices are low, we do get good demand from producers around the world. Big news in the potash industry, of course, was the merger between Potash Corp and Agrium. Those Canadian producers overall have taken the idea that they're going to try to work down their existing inventories rather than boost production. That's the way other producers around the world, they're trying to grow their market share. So far, the strategy seems to be working. We've seen the Midwest price bounce up here a little bit on tight inventories, and looks like that situation could persist into the end of the fall applications season. Still no reason for prices to rally long term, and I think targeting that $280 to $300 an area is a good buying opportunity. Again, if you can lock it in now, I go ahead and get it. The crude oil market, trying to figure out if it needs to go a whole lot higher or a whole lot lower. My average price forecast for 2017 is $53 a barrel. That's $5-6 higher than where we're trading at currently. There's talk that OPEC might get together with Russia, some of the other producing nations, to put a cap on supplies. But if prices rise too much, that'll just bring U.S. and Canadian fields back into production. So a lot of uncertainty, and the only thing we're certain about in crude oil is that the volatility remains fairly high. So you could see $30 crude oil, you could see $70 crude oil, and you could easily see both of those. For buying diesel, prices firmed on seasonal buying from farmers. Farmers are the swing factor in demand. So as they buy for harvest, that tends to increase prices. This is the wholesale pipeline price. Now that should begin to ease. The dealers have their inventories now for their fall needs. The best time to buy diesel is in winter, January, February, when farmers aren't using it. Propane prices also tend to follow crude oil prices. Now, it used to be that the best time to buy propane was in late winter, early spring, when dealers were dumping inventories. Propane isn't used as much for home heating anymore. And we've started to see, with the big increase in production, the prices bottom out during the summertime. That's happened the past couple years, partly due, it seems like we've had big financial concerns. We had the Chinese stock market meltdown, the Brexit vote this year, the Greek crisis 2 years ago. All these things tend to happen in the summertime, weakening crude oil and weakening propane prices as well. Again, you want to watch those two windows for buying your 2017 propane, late winter, early spring, and then again during the summer. Now, for 2017 corn prices, the supply and demand outlook doesn't look very promising. Even if we cut acres, and I'm using a yield of about 167, that's my average, still results in a crop of 14.2 billion bushels. That's equal to demand, keeping ending stocks well above 2 billion bushels, and not really doing much for cash prices, and maybe indicating, if we get a rally, might get up to $4 on the board. This is the profit and loss per acre at different yields and prices for 2017, showing a lot of red, and really until you get up either with very high yields or above $4, $4.25, before you can feel comfortable hedging. So I don't think you do anything now. I'm not a big fan of selling at a loss for corn or soybeans. The 2017 corn futures have come up a little bit, still not offering much of an incentive to sell. Like to see that contract get up to this summer's high before start making sales again. Potential perhaps for that to happen over the winter, most likely on a rally in soybeans. Now, I think the soybean market needs acres, and the best case for a rally is a rally to buy acres. We used to see those. I haven't seen them in the last couple of years, however. Now, for soybeans, even if we increase acres a little bit, I'm dialing back my average yield to 47, just over 47 bushels per acre. That would mean a crop of less than 4 billion bushels, well under demand, and keeping ending stocks tight. raising the average cash price under this scenario to $11 and producing big rallies, talking 12 to 13 bucks. Now, soybeans tend to be a self-correcting market. As soon as we start to rally, we're going to lure more acres into production both here and in South America, so we probably never would reach those price objectives. But I think there is potential to get prices up to the 1050 level or higher, and this is the profit and loss per acre for 2017 soybeans, that yellow line, 47 bushels per acre. You get prices up to 1050 and you can start penciling in a profit. Again, with soybeans, I don't see any potential for selling soybeans at a loss. I just think that's a bad strategy. Patience tends to be a virtue. 2017 bean contract has come off its lows, trying to break out of this wedge here. May not be able to do that for a while, but the soybean market, again, trying to, I think, turn a corner here. So we'll have to watch that, and just in case those hedging opportunities start to come earlier, say on a South American weather problem. Now, you can get all of these charts and all this information for free online. We update the weekly reviews on a regular basis. You can also click on the subscribe tab on the top of our website and sign up for Farm Futures Daily. That's our morning and afternoon comments that include my recommendations for what you should be doing. Also like to put in a plug for our Farm Futures Business Summit, January 19th and 20th in Bettendorf, Iowa. Some people go to Florida in January. Maybe put off that trip a little bit. You get to hear not only from me, but from a lot of other outstanding speakers on finance, technology, family planning, and transition issues that can have a big impact on your farm. Get to network with a lot of outstanding growers. We have farmer panels too, so this just isn't us talking heads talking. So thanks for listening, and we'll be having more of these online webinars later during the season.